Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hey, yo.
We have lots of clients that come to us sometimes that find, the idea of rental properties and things like that really appealing. And then there's other people that wouldn't even consider it, like not even go there, which makes sense because I think that this is really a big question of personality types as well. But today we want to talk a little bit about, does rental properties in general, do they make sense financially? Do they make sense right now? And we're not experts on real estate. We can't give you specific recommendations on whether you should buy or hold or sell a specific property, but there are some basics regarding how owning and renting out property works. So you can kind of decide for yourself and have some tools to make those kinds of assessments in a logical way. But the basics is, often when we're talking about rental properties, we're talking about using debt and the leverage to potentially make money, which means more risk. Basically, your potential return is a little bit higher because you're using debt, but your ability to lose money is also higher because you're using debt. So it's a big catch 22 there. And honestly, you have to have some confidence about what that makes sense and be willing to take on some extra risk in order for this to really make sense for you.
I think the easiest way to conceptualize that is like, let's say, I mean, we have another example here, but let's say you buy a $500,000 property and you pay cash for it. And let's say the 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 property value goes down by 20% and you sell it. So you sell it for 400,000 and we're ignoring like fees, commissions, et cetera here. So you lose $100,000 or you have a 20% loss on your investments. Well, let's say you put a 20% down payment. Instead, you bought the property of $500,000 with a $100,000 down payment, and then you took out a mortgage for the remainder. And let's just pretend your renters cover the full mortgage. So your out of pocket investment is 100,000 in this scenario. Property value drops by 20% to 400,000. You sell it, your mortgage is, we'll just say it's 400,000 still because it's barely gone down in the first handful of years. You now have a 100% loss on your investment. That 100K is wiped out because you have no equity in the home anymore with that outstanding debt balance. So, but if the property values go up, like let's say you have a 20% increase in value, your 500K property goes to 600,000. Well, if you paid cash, all right, you made 100,000 or a 20% rate of return on your money. If the 500K property goes to 600,000, you have your 400K mortgage, you sell it, you net 200,000. So you doubled your money. You put in 100 down, you walked away with 200, you just doubled your money. So 100% rate of return. So amplifies the returns, also amplifies the downside on the risk spectrum.
Yep, absolutely. And I think that's a really good basic example. And obviously, everything in real life is more complicated than our basic examples. But to use one that's maybe like a little longer term, let's use the same 500K property and say we have $100,000 in cash to put down a down payment. And then let's assume that between now and when the mortgage is paid off, you're covering your costs with your rental income. So, and maybe this is a little bit of a stretch in some scenarios, but we're covering the mortgage, the interest, the property taxes, any HOAs, any ongoing repairs, like all of that kind of thing is taken care of, and you're kind of net even on your monthly cash flow with this property. In 30 years, let's say the mortgage is paid off and there's very, little extra cash flow from you at that point. Now you have some passive income. But if we assume a 5% appreciation rate, which may be a little ambitious, but is fairly, similar to what it has been in a lot of places recently, then that home is now worth $2.15 million or about that. And that's about a 10% return on your initial investment of 100,000. If you paid in cash, then you get that 5% appreciation rate plus whatever income you kind of had generated from it. So, there's some potential to have a higher rate of return because your costs are being covered, like your costs of managing that debt are being covered by your renters. But, in reality, obviously, this isn't always going to work out so cleanly.
Yeah. And if like you said, the 5% might be a little ambitious. I think historically residential real estate has appreciated in line with inflation, maybe a little bit higher than inflation. So call it 3 to 4%, but I've seen other data, and it depends on your starting point and ending point and what source you're looking at. I've seen other data that it puts it closer to like 4 or 5%. Um, so the numbers change depending on how you want to play around with them. You could tweak a few things to make arguments in your favor or against whatever you're thinking. And then there's also the dynamic aspect of real estate. Like property taxes will increase over time. Maintenance expenses should increase over time just due to the property aging and needing more frequent maintenance, but also the cost of labor and materials going up. But hopefully, you can raise rents over time and the rental income should increase. And if it works out well, ideally the rental income increase will exceed the cost increases because your fixed cost of your mortgage, hopefully you're doing a fixed rate mortgage, but even if it's adjustable, like your mortgage payment should hopefully be relatively fixed over time. So really the variable costs are the maintenance, management costs,
Insurance.
insurance, taxes,
Hmm.
and then the rental income is a big variable one. Again, hopefully it goes up, but no guarantees of any of that.
Yeah. It's really important to talk about the risks and like state what they are when we're talking about rental properties. There's risks with every kind of investment. Otherwise, you wouldn't get anything from it usually. So, risks for rental properties include like repairs, but especially large and expensive repairs, replacing a roof, like having damage to a property that's not covered by insurance for whatever reason, having to replace a water heater, that's not going to be covered by insurance. Not being able to collect rent for whatever reason is a huge risk. Either not being able to fill the property, like not having a vacancy for any number of months, or just not being able to collect rent because someone's not able to pay you. Like getting a renter that's not able to pay you out of your property is not easy in a lot of places. So if you are going to buy rental property, it's important to know what that looks like where you live. Just, what does this look like if someone can't pay me? Like this is my income and my cash flow as well. So obviously that will affect you. Home prices going down instead of up. If you start to lose value on the property that you own, that can be a big deal. If you're willing to hold on to it long enough, probably not as big of a deal. Rents decreasing while costs increase. So especially in economic downturns, if we have it, a time period of deflation, like that can be a big deal. And tax laws changing. We're making decisions right now based on the way the tax law is written currently, but it doesn't stay stagnant. Tax laws change all the time. Not all the time, but frequently enough that it's very important to be prepared for some uncertainty there.
And it could be like a beneficial change that helps you. It could also be adverse. We don't know. And I think I've got an example later. Back in the early 80s, I guess we could just jump around here.
Yeah.
Um, Limited partnerships were a big deal in the early 80s. There was, a lot of tax benefits associated with them. So a lot of people invested in real estate projects through these limited partnerships because they could get potential returns and a lot of tax benefits to help lower their taxes. And then thanks to the Tax Reform Act of 1986, it changed some of the tax perks associated with limited partnerships to where they were no longer as attractive as they were a few years prior. And a lot of developments just blew up. I think the classic example is in Florida. All the big developments down there. A lot of them were financed through these investments in limited partnerships. They go belly up because the financing dries up. People aren't going to invest if they don't have the perks associated with the investment anymore. It's kind of like more recently the opportunity zone investments. If you buy real estate in certain designated opportunity zones, hold it for a certain amount of time, you avoid paying capital gains taxes, et cetera. If so that and incentivize a lot of people to invest in less desirable areas than one would normally want to invest in. And if it holds true and the tax laws stay the same and the area grows, like it could be a great benefit to them with some tax perks. But if those tax benefits are removed or changed, that could change the inflow of capital into those areas, and therefore the potential investment returns could not be as attractive. So you just never know. You never know.
Yep. There's always some unpredictability. If you've kind of decided that this is something attractive to you, you may want to evaluate different types of rental opportunities. And I think there's some that people automatically think of. We have like single family homes. Sometimes it's your own starter home. Like let's say you purchased a home, it was great for the first 4 or 5 years that you owned it, but now your family is growing and you'd like to move into a larger space. A lot of people keep their first home and end up turning around and renting it out at least for a while. And this can be especially attractive right now just because a lot of people have mortgages or existing mortgages with fairly low interest rates. And so if you can basically take advantage of the fact that you have a 2.5 or 3% interest rate on your home and turn around and rent it out and cover your costs easily because that interest rate is so low, that can be really attractive. There's like multifamily residential properties. If you own a duplex and you rent out both places, you can even potentially do like an owner occupied residence where you live in one part of a multifamily residential property and you rent out the other part. You can potentially avoid some costs that way and potentially avoid like capital gains taxes and things like that, which we'll talk about in a little bit. But having multiple families in a rental home or having like a multifamily residential property also diversifies your risk a little bit. Now you're not just depending on one renter to cover all of your costs. Now you have several renters or maybe just, two renters in a space that's helping you cover the cost on that mortgage. So even if you're not able to fill one unit or one renter is not able to pay, like you still have some income coming in to help you cover your costs.
Then
Uh,
there's the
yeah.
commercial side. I guess we don't really get into commercial real estate per se today, like, buying office buildings or hotels or stuff. They exist, but more so like I think for most of you, some of you, if you're in private practice, you might own your office building, depending on your location. But I think the more common route for individuals would be investing in a syndication where a bunch of people pool their money together. You're more or less a silent partner, just putting some money in the pot, basically a limited partnership. There's going to be a general partner or group that oversees the decision making and deciding what properties to invest in, management of them, etc. And the objective is for you to just passively invest, not have any active involvement in it, but hopefully get a return on your investment. And they'll give you projections like, all right, we're buying it for this much. Here's what we anticipate the expenses to be. Here's our holding period timeline. And then after 10 years, our plan will be to sell the property. Hopefully we can, generate this much income along the way and then sell it for X amount. And if that all holds true, this will magically be your expected return. It's not going to pan out that way. I can promise you. It could be better. It could be worse. Could be close. But yeah, the whole point there is you don't want to be as actively involved. So it's a way to still invest in the real estate asset class and maybe even you kind of have a say. Like if they tell you what properties they're buying, hey, we're buying this hotel on this street in this city. We're, fielding $20 million to purchase it. You can invest minimum investments 100,000, so you can decide, all right, do I want to be a part owner of this hotel or not? And then, you have a say in what the property is that you're buying. But that's about the only thing you have a say in is which one of these syndications you want to invest in and how much money you want to put into it. But you don't
Yep.
have a say of, how much rent to charge, when you get to sell it. So your money is going to be likely locked up until they either start distributing cash flow or until they decide to sell the property. But it'll be on their terms, not yours.
Yep, absolutely. If you are thinking about doing residential real estate, one other consideration can be like short-term versus long-term rentals, which can depend a lot on geography and like neighborhoods and things like that. Um, I think being in medicine, I feel like I have a handful of clients that are renting to like traveling nurses and things like that, which is kind of nice because it's a short-term rental, but it's maybe like a couple months. So you have someone in there for a couple months and it's pretty like stable in that way. Um, and short-term rentals can potentially yield higher rents. You can potentially collect more because you're charging, for a shorter period of time, but it's also much less stable. Like you don't know what your occupancy rate's going to be necessarily. It gives you some flexibility too if you want to potentially use the property yourself once in a while. This can be especially attractive for like vacation rentals. But that does have some tax implications, which we'll talk about in a second. If you do decide to go like the long-term rental route, that's usually a bit more stable, although obviously, you could have a renter not able to pay rent and things like that as well. But it's just, you have someone in there usually for a year lease. And a lot of times, that same person turns around and signs another year lease. And I've had also clients be like, okay, that like this is my property that I owned in residency. I think it's going to be a great property to rent out because it's right near the hospital. I think we can get residents in there. I think that, and just rent it out that way. And that's been really successful for a handful of clients that I have.
Yeah, I know a number of folks that do short-term rentals, the Airbnb deal, and it works out well. I've also, heard opposite story. It really is, uh, there is a lot of luck involved to some degree. I'm sure the harder you work, the more you study it, the better understanding you have of the markets, et cetera. And if you can get a property at the right price and management costs and financing, et cetera, um, you could increase the probability that it'll be a positive cash flow. But yeah, like I have some clients, they own a couple Airbnb properties that more than covers the costs associated with the property plus their own mortgage on top of that, and they're making some real income for their finances, and it's fantastic when it works out that way.
Absolutely. So that brings us to an important thing, which I think is running the numbers. And obviously, some of the numbers are going to have to be assumed because we don't know exactly what they'll be. But there are some things that you absolutely know, like what your mortgage payment's going to be. So the costs vary dramatically from place to place. So if you are open to looking in like broader places, geographically speaking, you can take that into consideration. There are some cities where it is less expensive to buy than to rent. So if you can buy a fairly inexpensive house, but then turn around and rent it for like a higher relative dollar amount, that can be really helpful. You can also think about, what neighborhood is this in? Is this going to be attractive to families? Is this going to be attractive to students? Like, what kind of renter do I want? What kind of renter feels more stable to me? All of those kinds of things are really great to take into consideration. And then I think a really important one for most people is whether or not the property cash flows. So that's really like, can I cover all of my costs with the rental income I can potentially collect? And a real estate agent can potentially be helpful with this because they can have their pulse on the rental market as well. But it's very much like in this neighborhood, like, will I be able to charge enough rent that I can cover the mortgage, the interest, the insurance, the taxes, any HOAs that we may have, all of those costs, or at least very close, so that I don't have a lot of out of pocket expenses, except maybe the unexpected ones, which will happen as well.
Yeah, I think that's the biggest thing, and we can get into the weeds with details and numbers and variables, but I think to simplify it, is this property going to make you money or cost you money? And that can be a pretty easy deciding factor in the equation. And you can there's websites like property management companies in addition to the real estate agent. Like you could just talk to a property management company, which I highly recommend. I mean, maybe if you just have one property, you could do the whole listed on Airbnb yourself if it's a short term, and hire a cleaning crew that comes in on the schedule. But for longer term rentals, and even shorter term for that matter, like if you don't want to deal with the headaches of fixing a leaky toilet, repairing a window that won't lock, like the sprinklers aren't working properly, whatever, like you can offload that to a management company for a cost, of course, but for most doctors out there, they have more money than they have time. So you'd rather pay someone to take those headaches off your plate than have to tend to them yourself, 24/7 potentially.
Yep.
But like, is this property going to make you money? And the property management company, the internet sites, like they could give you a pretty close idea. Here's what you can charge for rent in this neighborhood. And then the costs, they're pretty straightforward. You know what your mortgage is, property taxes, insurance. You get all those hard exact numbers. The one variable would be maintenance costs, but you can kind of do a good analysis of the property and see what major expenses are on the horizon, how old's the roof, how old's the water heater, etc. And then I've seen various rules of thumb ranging from probably 1 to 1.5% you can expect on average to spend in maintenance. The bigger expenses are going to take up a couple years worth of that average, and then there'll be some years where there's just hardly any maintenance expenses required.
Yeah.
But yeah, run the numbers. Is this going to cost you money or is it going to make you money? If it's going to cost you money, maybe we look the other way. And then another good rule of thumb, which is darn near impossible to achieve right now, but it's that 1% rule of thumb, is if your monthly rent can equal or be greater than 1% of the purchase price, then it's probably going to be a good investment. So if you're buying a $500,000 property to rent out, if you can rent it for $5,000 per month, great. It's probably worth pursuing. If you can only rent it out for 2,000 a month, it might be tough to make money on that property.
Yeah. I think one thing that's maybe a little bit of an elephant in the room is the interest rate environment. So interest rates have a huge impact on what your monthly costs will be. And right now, if you have an existing mortgage with a low interest rate, your costs are fairly low compared to what a new mortgage would cost you. New mortgages right now are like 7% or something like that. It's much, much, much higher than it has been for a long time, which means mortgage payments are much higher. So it's really challenging to find a property, purchase a property, and be able to rent it and cover all of your expenses with a new mortgage. The other thing is that, buying and financing a rental property, your interest rates are generally higher than if you're buying a primary residence, and the down payment requirements may be a little bit higher as well. So that's another thing that you just need to kind of be aware of when you're thinking about this. You're probably going to need at least 20%, maybe 25, and your interest rate may be a little bit higher than you even think it's going to be.
The other consideration is getting approved for the mortgage amount, which if you're doing a good job with your finances and living within your means, it shouldn't be too much of a problem to get approved for a rental property. But if you're already a little bit stretching the limits on your primary residence mortgage and some other debts you might have, you're basically taking on another mortgage when you're financing a rental property. So can you get approved for mortgages that add up to that total? And unless the property is already a rental and it has been for about 2 years or more, you typically can't factor in the rental income into the equation. So if you can show a bank, hey, this property generates $3,000 a month in rental income, that will help cover my mortgage costs. That's fantastic. But if it hasn't been a rental up to this point, you're planning to turn it into a rental, you're not allowed to include your expected rental income into the equation. They want to see hard data that shows here's what I've been earning from it the last couple of years. So
Yeah.
that's
You may
another
be willing to
wrinkle.
take a risk, but they might not be willing to take that risk. One other thing, like financially, that's a really good thing to consider is that you should have a separate emergency reserve for your rental. Like it shouldn't have to dip into your personal emergency reserves in order to repair a water heater or something like that. So ideally, you have some cash set aside in case you need to come up with some money to do some repairs to your property, which happens, like absolutely. So that's something to keep in mind. What are your cash positions right now? Are you comfortable shifting some of that to just like some backup for this rental property and knowing it's not going to do a whole lot for you while it's sitting around?
I also would encourage you probably talk to an attorney because we're not attorneys and can't give legal advice, but I've heard enough that you should probably not own the property yourself. Put it in a separate entity like a business
Like an
LLC or a
LC, yeah.
trust or something of that nature. So it's a step removed from you personally. Because that way, if something goes wrong with the property and the tenants want to file a lawsuit, if you own it personally, you're personally exposed to that. But if it's held within its own separate business entity, you're a bit removed from that equation. So it can help you from a asset protection standpoint. I don't know all the ins and outs and the rules of it, but it's worth consulting with both a tax professional and a legal professional on that one.
Yep. I think generally as things get more complicated, it makes sense to have some people in your corner. And this is definitely one of those things that makes things a little bit more complicated. And probably another consideration, like, do I want to keep things simple or do I want to take on this thing that's maybe a little bit more complicated but attractive in some ways? Yeah. Yeah.
Speaking of taxes,
I know. So I think this is a huge reason that people sometimes argue rental properties are attractive is because of some of the tax implications with rental properties. So there are tax deductions potentially for most folks with rental properties. An accountant can be really helpful. So we just talked about an attorney, get an accountant also. I think especially if you're just starting out with rental properties, like after a couple of years, maybe you kind of understand the ins and outs of what you can deduct and things like that. But it's hard to get the pulse on that at first. A few things that you'll want to look at is like depreciation, repair costs, mortgage interest, lots of tax deductions that you can potentially think about. If you're using the property, like if it's a short-term rental and you use it partially for personal use and partially as a rental, it's going to have a totally separate set of tax implications. And so that's something to be aware of as well. You may not be able to deduct as much depending on how much you use it for personal use. So that's one thing to keep in mind. Um, the big thing is that you can typically only deduct expenses on investment property from the income generated by that property. So typically you can't deduct net losses from your personal income, but you could potentially offset like capital gains and dividends elsewhere in your tax planning. So if you have capital gains and dividends in a brokerage account, you could potentially use passive losses from your rental property to offset those gains.
and this gets
Again,
back to the
yeah,
cash flowing.
yeah, absolutely.
If you're losing money, great, you might be able to save on taxes, but you're still losing money. Like you lost $100, but it saved you $40 in taxes. I'd rather pay the extra 40 in taxes and keep the $100 or the $60 in my pocket after
Yep,
the fact.
absolutely. On the opposite side of tax implications, so we have tax deductions, but we also have, like you have to pay taxes at a certain point when you're earning income, but also if you sell a property and you trigger capital gains. So the rule for capital gains is that you do not have to pay capital gains taxes up to $250,000 if you're a single filer or 500,000 if you're married filing jointly on your primary residence. But if it's a rental property, you do have to pay capital gains taxes on that growth. So the rule to establish if it's your primary residence or not is that you have to have lived there 2 out of the last 5 years. And this comes into play if we're taking like that starter home and then we're turning around and we're renting it out. So sometimes that can be a good way to kind of dip your feet in. Like, is this something that I want to explore? Is this something that I want to do? So if you have your primary residence and then you've lived there for a few years and you decide you want to try renting it out, decide in that first few years if you want to keep doing it long term. Because if not, you probably want to sell it with when you're within that like 2 out of 5 years window. So that can be a good thing just to keep in mind.
You'll see a lot of real estate developers who build houses for a living do this every couple years they move. They'll build a house for themselves, move into it and live there. And then obviously the cost to buy that house, like they're not paying any of the markups or the builder markups or the real estate agent commissions, things like that. They're just building their own house. So if, on the open market, it's $1 million house, maybe they can build it themselves for $700,000, move in several years later, sell it for 1.1 million. All right, they just made 400,000 when in a normal scenario they'd be like breaking even after all the expenses associated with that transaction. And then they move into the next house that they build, and they don't have to pay capital gains on that because they get the primary residence exclusion of living there for at least 2 years.
Tricky, tricky.
Hmm.
Yeah.
So if you want a second career and get out of medicine into a more volatile
Be a
industry that
developer.
has a lot more risk and have to deal with hiring and labor and things, yeah, there's an option for you.
Absolutely. One other thing about capital gains is that with rental properties, you can do something called a 1031 exchange. So if you have a property for a long time and you're renting it out and it would absolutely be subject to capital gains, you can potentially sell it and buy a like property within a set period of time. And then those gains get rolled into the next property. So you still have gains that are, within that property, but you don't have to pay taxes on them yet. They get rolled forward to when you sell that property at that point in time. It's kind of complicated and it's somewhat challenging to accomplish because of the time frame that you have to do it within. But lots of people use that rule to their advantage.
And it's one, like Rochelle said, very complicated. There's a bunch of rules and hoops. You have to declare you're going to pursue a 1031 exchange, have the next property identified. It has to be a certain type,
Yep.
similar, etc. Um, it's very useful, especially if you plan on holding onto these real estate properties until death, because when you die, under current tax rules, the property gets your heirs get a step up in basis, meaning the cost that you paid for the property automatically increases to the fair market value of that property on the date of your death. And this goes for other investments too. Like if you own stocks or mutual funds or whatever, you have to pay taxes on the gains when you sell the investment. But if you hold them until death, your heirs who inherit that account, those investments, the new cost basis for them is whatever the account value is on your date of death. So if they sold it right away, they wouldn't pay any taxes on all of the gains that you had previously earned. So that's a huge, huge benefit for folks that want to create generational wealth. They can pass their investments on to their heirs, and basically the potential capital gains from those appreciated investments go away. It just
Yeah.
vanishes. And but if you were to sell the property before you die, you're just prolonging the inevitable by doing these 1031 exchanges, because you're just going to have to pay a much larger tax bill later on if you've rolled your capital gains from previous sales into the new one.
Yeah. With the investment accounts, it's important to note that it's not retirement accounts. That doesn't work for retirement accounts, just for like brokerage accounts and things like that. But just as like a really basic example, let's say you purchased a property for $200,000 in like 1995. And then over time you like put some costs into it. So maybe your cost basis is like $250,000 or something like that. But now it's worth 900,000. Like if you sell it before you die, you pay taxes on that. What am I at? $650,000 of gain. But if you pass away and your heirs inherit it, their cost basis is 900,000 because that's the value of it. So that is a huge difference, like huge, huge. One other thing about the taxes though is that the value of that property, the value of everything you own is part of your estate, and you may have to pay some estate taxes, which is different than like the capital gains taxes. But that's still something that you'll have to consider depending on the size of your estate.
And there's some tricks that you can do there, like putting a property in a irrevocable trust that goes to your heirs, or have it generation skip
Get
into
an
your
accountant.
grandkids.
Get an attorney.
Yeah, or gifting it to charity, whatever. So there are ways to avoid or minimize those estate tax implications. But again, those tax laws change. We've alluded to it before. Right now, the federal exemption is pretty darn high. If you're a married couple, it's like, what is it now? Like 27 million, I think. But it's set to get cut in half in 2026
Hmm.
unless they change some things. And it changes over time. There have been periods where there's been no exemption, meaning like you don't owe any estate taxes. There have been periods where the exemption is as low as 600,000, meaning if your net worth is above 600,000, you're paying federal taxes when you die. Every state is different too. I think there's only about 9 or maybe a dozen states with state level estate taxes. Rochelle and I live in one of them, Oregon, where only a
It's actually,
million is
yeah,
exempt. Anything
yeah.
above that is taxable at death. But there's little tricks you can do there. Like you can create a marital trust to where when one spouse dies, a million goes into the trust, and then that way your combined exemption is 2 million, because you can each take advantage of that $1 million exemption. But still, it's again, how complicated do you want life to be? How many attorneys and tax professionals do you want to
To
involve?
pay.
Yeah, to get involved.
Yeah, it could be well worth it depending on the size of your estate, obviously. But when we're thinking about rental properties, there are some uses within your financial plan. I think the biggest one that people think of is passive income. Initially it's probably a very small amount of passive income because you generally have quite a few costs unless you're paying cash. Um, but longer term, as that mortgage becomes a smaller part of your overall expenses and maybe your rent increases, that passive income stream becomes larger. And once you pay off the mortgage, like that becomes substantially larger. It's a much better long-term strategy. If you're just getting started, it's not like you're going to retire in 5 years. I have a client who totally wants that to happen. He's bought like 5 rental properties now, and he's like, "Can I retire when I'm 40?" I'm like, "No, because you have mortgages on all of these properties. Like you're making like $100 on every one of them. That's not not going to put you through retirement in 5 years, but maybe in 25, like, but anyway, like I think it's going to be a long-term strategy, not necessarily like an immediate short-term payoff.
Yep. We talked about the generational wealth piece of it. If you plan to leave it to your heirs, it can be a good move from a tax perspective, in that they get that step up in basis. But it's also tricky too. Do your heirs want to inherit a rental property, or would they rather just have the money?
Mhm.
And if you have multiple heirs, like let's say you have one rental property and three children, how's that getting split up? So it yeah, some food for thought. We'll just leave it at that for the sake of time.
Absolutely.
Um, Other considerations, do you want to be a landlord? Again, you can outsource that to a property management company, but there's still going to be some things that you have to uh, deal with yourself, depending on how comfortable and how trustworthy you are of that landlord. Like you might set a price point like, hey, anything under $1,000, don't even talk to me about it. Just take care of it. But if it's more, run it by me. We were in a rental when we were moving here. Um, the owners were, even the property manager was complaining to me one day about the owners because like literally everything, the garage door opener wasn't working. And they like, I'm like, hey, can we just get a new remote? Like we've changed the batteries, the thing's dead. And they had to schedule a maintenance appointment, send the person out there. He had to like do all sorts of troubleshooting things. And he's like, all right, I have approval to replace your garage door remote, but this other thing that's not working, I need to get approval for before we can fix it. I'm like, come on. And then you're like the one maintenance person for this entire property management company. So I got to wait 2 months for you to come back out. Like it's, but yeah, so it's anyone who owns their own home knows there's always something that's going on that needs to be fixed, repaired, taken care of. So it's going to be the exact same with a rental property. It's not like houses magically don't require maintenance because someone else is living in them. It's going to be the same story.
It may be more maintenance because in your own home, you can just ignore stuff. But your
That lights
renter's
out, nah,
probably that. Your
we don't
renter's
need
probably not going to do that.
we don't need to change that light bulb for 3 months.
Story of my life, Corey.
Yeah, that our
So
fire.
another consideration though is just, is your risk tolerance high enough for the potential pitfalls of rental properties? Are you gonna just be really uncomfortable if you can't collect rent for a few months? Is that gonna make you squirm out of your skin? Like those are the kinds of things that you want to think about as well. Just make sure that you are prepared for things to not always go perfectly because they will not. Yeah.
Yeah, between we talked about maintenance, you could have bad tenants, management costs, vacancy, tax law changes. There's a lot of variables out of your control. There's definitely some luck involved. Do you get the good tenants who pay on time, take good care of the place? Does real estate prices appreciate in your area? Like no one can predict the future. I don't think anyone expected in the beginning of the pandemic that it was going to spark a national housing craze that would jack up prices 50% over the next 3 years. Like it just is, it's so unpredictable. Interest rates, good luck predicting interest rates. I challenge all of you, write down right now what you think the federal funds rate's going to be a year from now, or pick your rate, the prime rate,
What is it right now? Like
the
5 point whatever,
I think they're targeting 5 to 5.25, right? So even we don't know, but we can Google it.
something like that.
Somewhere around that. So yeah, write down what you think it's going to be, and I can almost guarantee you it's going to be wrong. Maybe you'll have the
What if
general.
it's close to right?
Then we can. Well, let's go back to our
I'm
five
doing it
dollar
right
bet.
now. I'm guessing 4%, but I feel like that might be
A
optimistic,
year from
honestly.
now, I'll
Yeah.
I'll go higher. So we're if it's
Yeah.
I'm gonna go 4.5.
Okay.
Um,
I knew I was being optimistic.
but I could make an argument that it could even be higher than it is today. So. Anyways,
Okay.
I think the general consensus it'll be less, but
Who
the
knows how
general
much less?
consensus is often wrong. So,
Yes.
anyways, hard to predict what could happen. There is some luck involved, but if you do your homework and you do proper due diligence, you could increase your luck surface area to where the odds of it being a positive investment for you are are increased.
Service area of your luck. I like that,
Mhm.
Corey. Yes.
Yep.
So, in summary, I mean, does real estate interest you? And if not, just don't do this. Like, why would you do it if you didn't want to? Like, this is something that's challenging and risky, and like, only do it if you really want to do it. Bottom line. The next question to ask yourself is how involved do you want to be? If you want minimum involvement, some sort of passive investor relationship with a real estate fund or something like that may be a better fit than owning and managing properties. Or, maybe you want kind of that middle ground where you own a property, but someone else manages it for you, which is perfectly acceptable if you're willing to take on that cost. And then, are you prepared for the headaches? It's not going to be easy all the time. There may absolutely be times when it's pretty simple and straightforward and you have a good renter and the house is doing good and all that kind of stuff. But there will be times when it's headache inducing and stressful and you have to be willing to kind of go with the flow with that. But like anything, it takes a lot of work to be successful. So this is not something that you necessarily want to go into thinking, oh, I can spend like 2 hours a year on this and just have this thing happening for me. That's not what's going to happen. It's going to take some work, whether you have a landlord or not a landlord, but like a rental company or what am I saying? What a property management. That's the word I'm looking for. But whether you have that or not, there's definitely going to be some work that falls on your shoulders as well.
Yeah, I think real estate being a passive investment is a misnomer.
Yes.
It's definitely more hands-on than most other investments out there. But but yeah, it can work out great for you. It could also work out terribly if it doesn't go right. So again, make sure don't just wake up one day, decide I want to invest in real estate and buy the first thing you see. It's not like you walk into a grocery store, go to aisle 2 and let me get this real estate thing and call it a day. It's you got to make sure you're doing your homework, consulting with the legal and the tax professionals, and really putting some thought into it to make sure that your luck surface area is as wide as possible.
I love it. Thank you for listening, everyone.
Have a good one.